The biggest recession of our lifetime. The 21st century is as economically volatile as the two before it. During this time period, several financial crises hit multiple countries, regions, and even the global economy with the Great Recession. All financial crises have similarities, yet each has its own story and lessons for the future. Recession fears are rising, but what is it? You'll find the answers to this and many other similar questions. In other words, hello there, and once again, we welcome you to Finance Basics. In this video, we will learn about the worst economic downturn or recession. Without further ado, then let's get started. With the U.S. economy on the edge of another recession due to the coronavirus pandemic, social media users of all ages are debating which generation has suffered more from earlier recessions. Generation Z, those born after 1997, and some younger millennials from age 23 to 39 are about to experience their first recession as workers. Many older millennials enter the workforce during the 2008 financial crisis, only to face another catastrophic depression a decade later. Generation Xers, those born between 1965 and 1980, are quick to point out that they've also experienced financial catastrophes, notably the dot-com bubble crash. An analysis by the St. Louis Federal Reserve shows that Gen Xers had twice as many assets during the 2008 crisis as the average millennial, who's now facing another recession. Every generation will certainly experience a recession. Some baby boomers born in the 1940s have lived through a dozen. Economists define a recession as 2 or more quarters of declining GDP growth. The U.S. economy made a record last year by starting and concluding a decade without a recession. Average recession length since 1900 is 15 months. Since the Great Depression ended in 1933, the U.S. economy had entered 13 recessions by 2020. Here's every U.S. recession since the 1930s, according to the NBER. Coronavirus decline. The global economy has not yet entered a recession, but economists anticipate the coronavirus pandemic will reduce U.S. GDP for at least the first 2 quarters of 2020. The economy would have entered a recession after a sustained GDP fall. If so, the looming recession will follow a decade-long economic growth of 126 months as of December. In the past 3 weeks, 16 million Americans applied for unemployment, or 10% of the workforce. Goldman Sachs predicts U.S. unemployment might hit 15% by mid-year, and GDP could drop 34% in the second quarter of 2020. Inflation, December 2007 to June 2009. GDP decreased by 4.3%, and unemployment hit 10%. The 18-month recession required enormous government support, including a $700 billion bailout of the financial industry, insurance and auto companies, and another $800 billion stimulus program. It happened toward the end of the subprime mortgage crisis, which devastated the U.S. housing market and home values. Numerous financial firms that had bought high-risk mortgage-backed securities saw their portfolios wiped out as borrowers failed. Bear Stearns, Fannie Mae, Freddie Mac, and Lehman Brothers all fell in 2008, causing a stock market disaster that saw key indexes lose more than half their value. $2.3 trillion in Fed economic programs. Dot-com bust, March 2001 to November 2001. Overinflated NASDAQ lost 75% of its value in 2000, wiping out a generation of IT investors. These losses left the stock market vulnerable, which worsened in the fall of 2001 after the September 11th terrorist attacks and major accounting problems at Enron and Swiss Air. The S&P 500 lost 43% between 2000 and 2002, while the NASDAQ didn't reach its 2000 peak until 2015. The 8-month recession was brief, with a 0.6% drop in GDP and 5.5% unemployment. Gulf Recession, July 1990 to March 1991. In 1990, after rising interest rates for 2 years to control inflation, a modest recession began. These policies hampered the economy, which took a knock when Iraq invaded Kuwait in 1990, followed by U.S. involvement in the Gulf War, and caused world oil prices to double. In 8 months, GDP fell 1.1%, and unemployment reached 7%. Energy Recession, July 1981 to November 1982. The early 1980s are considered as having been a double-dip recession because there were 2 so close together. In 1981, the Federal Reserve tried to manage growing inflation by raising interest rates and slowing the economy. These tactics reduced inflation to 4% by 1983, but also caused a 16-month recession with a 3% reduction in GDP and 10.8% unemployment. A new Iranian administration reduced oil output, rising global oil prices, exacerbating the recession. The economic upswing that followed is frequently credited to President Ronald Reagan's tax cuts, increased defense spending, and the Fed's decision to lower interest rates. Recession 1980, from January to July 1980. Inflation reached double digits in 1979 and 22% in 1980. The Fed boosted interest rates to combat increasing inflation, which slowed the economy. GDP declined by 2% and pushed unemployment to 7.8%. Mid-1980, the Fed dropped interest rates again, ending a 6-month recession. Oil embargo downturn, November 1973 to March 1975. OPEC embargoed oil shipments from the U.S. and other countries in 1973 for supporting Israel's military. As a result, oil prices quadrupled, putting a tremendous strain on the economy as consumers cut back on spending. President Richard Nixon's price and wage restrictions harmed the economy, and a 1973 stock market crash caused a 2-year bear market in which the Dow Jones lost 45% of its value. The resultant recession lasted 16 months. It outlasted the oil embargo, which OPEC lifted in 1974, with GDP falling 3.4% and unemployment rising to over 9%. 1969 to 1970 recession, from December 1969 to November 1970. The 1960s began and concluded with recessions, but there was a sustained economic expansion that led to rising prices. The Fed tightened monetary policy and rising rates, and Nixon slashed government spending. The mild recession that followed led unemployment to peak at roughly 6% and the GDP to decline less than 1% when the Fed relaxed monetary policy in 1970. 1960 to 61 recession. The Federal Reserve began progressively raising interest rates after the previous recession ended in 1958, causing another short-lived recession at the start of the 1960s. The 10-month recession saw the GDP decline roughly 2% and unemployment peak at 6.9%. President John F. Kennedy sparked a resurgence in 1961 with tax cuts and extended unemployment and Social Security payments. 1957 to 58 recession. This late 1950s recession lasted 8 months. As the government tightened monetary policy in the mid-1950s to prevent inflation, GDP declined by 3.7% and unemployment peaked at 7.4%. As consumer prices rose, spending fell. A global slump, which coincided with the 1957 Asian flu pandemic that killed 1.1 million people globally, damaged U.S. exports by more than $4 billion. The Dwight Eisenhower administration increased government investment in construction projects, including the interstate system, after adopting the Federal Aid Highway Act in 1956. After Korea recession, July 1953 to May 1954. This recession was caused by a shift in government spending following the Korean War, which lasted from 1950 to 1953. As the government cut security spending after the war and the Federal Reserve tightened monetary policy to contain inflation, the country's GDP fell 2.2% and unemployment peaked at 6%, which includes increasing interest rates. Rising interest rates reduced consumer confidence and consumption. After a 10-month slump, the Fed loosened its policies in 1954. Post-World War II recession, November 1948 to October 1949. After the war, there was an 8-month slump, but World War II's economic issues resurfaced in the late 1940s. This 11-month recession, in which the country's GDP declined by less than 2%, was called extremely moderate by economists, who ascribe it to consumer demand leveling off after wartime rations ended. Economists attribute it to a reduction in fixed investments, while veterans returning from war and competing for limited civilian jobs caused the jobless rate to jump to 7.9%. Post-World War II slump, February 1945 to October 1945. This depression was driven by a decline in government spending and GDP, which fell 11% as the U.S. transitioned from a wartime economy centered on manufacturing war supplies to a peacetime economy focused on providing civilian jobs for returning veterans. As the government altered manufacturing priorities, the recession lasted barely 8 months and unemployment peaked at 1.9%. The Employment Act of 1946 required the federal government to ensure stable employment and price inflation. Depression-era Roosevelt, May 1937 to June 1938. Modern economists call this 13-month delay in the nation's recovery from the Great Depression a cautionary tale. In 1937, when the country's economic recovery was still weak, FDR slashed government spending. Unemployment rose from 14% to 20%, and real GDP lost 10%. And that brings us to the end of the video. Feel free to let us know what you think about this video. And if you like this video, please leave us a like and subscribe to our channel for more amazing content. Thanks for watching, and we'll see you in the next one.